You know what nobody's talking about? The fact that silver just became the most critical metal in the global energy transition, and most investors have absolutely no idea what's about to happen to the price. While everyone's been focused on gold breaking records, silver's been quietly positioning itself at the center of the biggest industrial revolution since the combustion engine. And the numbers coming out of this one sector are absolutely staggering. Let me show you something that should make your jaw drop. Solar panel manufacturers consumed 140 million ounces of silver in 2023. That's already massive, right? But here's where it gets wild. The International Energy Agency just revised their projections, and they're now forecasting that solar installations will triple by 2030. Not double, triple. And every single one of those panels needs silver. There's no substitute that works at scale. None. Think about what that means for a minute. We're talking about going from 140 million ounces to potentially 420 million ounces of annual demand from just this one sector. And here's the kicker. Total global silver mine production last year was only 830 million ounces. So we're looking at solar alone consuming more than half of all newly mined silver within the next 6 years. Half. From one sector. But it gets even more interesting when you dig into why this is happening. China just announced they're accelerating their renewable energy targets. They're not just meeting their 2030 goals, they're trying to hit them by 2027. 3 years early. And China accounts for 80% of global solar panel manufacturing. They're building solar farms the size of small countries. I'm talking about installations that stretch for miles, covering entire deserts with panels. Each one of those panels contains about 20 grams of silver. Doesn't sound like much until you multiply it by billions of panels. And here's what most people miss. This isn't just about new installations. The solar panels installed 10 years ago are starting to reach end of life. They need to be replaced. So we're not just dealing with growth demand, we're dealing with replacement demand on top of growth demand. It's a double wave that's about to hit the silver market like a tsunami. Now let me tell you about what's happening in India, because this is where the story gets really compelling. India just committed to 500 gigawatts of renewable energy capacity by 2030. They're currently at about 180 gigawatts. That means they need to add 320 gigawatts in 6 years. To put that in perspective, that's like building the entire electrical grid of Germany from scratch, but making it all renewable. And they're dead serious about it because their cities are choking on pollution and they're importing 85% of their oil. The Indian government is offering subsidies that make solar installations basically free for residential users. Free. They're paying people to put solar panels on their roofs. And with 1.4 billion people and a rapidly growing middle class, we're talking about hundreds of millions of rooftops that could potentially get panels. Each house, each building, each factory, all needing silver-laden solar cells. But here's where the supply side of this equation gets really problematic. Silver mine production has been essentially flat for the last 8 years. We're not finding new deposits that are economically viable to mine. The easy silver has already been pulled out of the ground. And here's something that'll blow your mind. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So silver miners can't just ramp up production because the price is going up. They're constrained by the economics of the primary metals they're actually mining for. I was looking at the data from the Silver Institute, and they're projecting a supply deficit of 215 million ounces in 2024. That's the largest deficit in decades. And that was before these new solar projections came out, before India's massive push, before China accelerated their timeline. So we're looking at a deficit that could easily hit 300 million ounces or more in the next few years. Where's that silver going to come from? Well, it's going to come from existing stockpiles, from above-ground inventories. And here's the thing about those inventories. They're not infinite. The COMEX warehouses, which are basically the Fort Knox of silver, they're sitting at about 280 million ounces right now. Sounds like a lot, until you realize that's only about 3 months of global demand. 3 months. And a huge chunk of that is already spoken for, already allocated to existing contracts and industrial users. Let me paint you a picture of what happened in 2011, because history has a funny way of rhyming. Silver went from $18 an ounce to $49 an ounce in less than 6 months. It nearly tripled. And you know what caused that? It wasn't even a supply shortage. It was just increased investment demand from people worried about the dollar and inflation. We didn't have a structural deficit back then. We didn't have an entire industrial sector consuming half the annual supply. We just had some nervous investors buying coins and ETFs. Now imagine what happens when you combine investment demand with an actual physical, structural supply shortage driven by industrial consumption that cannot be reduced. Solar panel manufacturers can't just decide to use less silver. The technology requires it. The efficiency depends on it. There's no viable alternative that works at the scale and cost point needed for mass solar adoption. And speaking of investment demand, let me show you something fascinating that's happening right now. The gold to silver ratio is sitting at about 88 to 1. That means it takes 88 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. And in times of industrial demand surges or supply concerns, it's dropped as low as 30 to 1. So silver is historically cheap relative to gold right now, at the exact moment when its industrial demand is about to explode. Smart money is starting to notice. I'm seeing reports of large institutional buyers accumulating physical silver. Not paper contracts, physical metal. They're taking delivery, which is really unusual for institutions because storing physical metal is expensive and complicated. But they're doing it anyway because they understand what's coming. When institutions start hoarding physical metal, that's a signal you don't ignore. Now, if you're sitting on retirement accounts worth $100,000 or more, you might want to check out the free guide I put together on precious metals IRAs. It's in the description below. Shows you exactly how to get physical gold and silver into your retirement account without triggering taxes or penalties. Covers the whole process, the approved depositories, everything. Worth a look if you're thinking about protecting your retirement savings with hard assets. Anyway, back to this supply crunch, because there's another angle here that most people aren't considering. Electric vehicles. Everyone knows EVs use a lot of copper, but they also use silver. About 1 ounce per vehicle for all the electrical contacts, switches, and circuit boards. Doesn't sound like much, but global EV sales hit 14 million units last year, and they're projected to hit 40 million by 2030. That's another 40 million ounces of annual demand that didn't exist a decade ago. And then there's 5G infrastructure. Every 5G base station uses significantly more silver than 4G because of the higher frequencies and the need for better conductivity. We're talking about millions of new base stations being built globally over the next 5 years. Each one needs silver. The telecommunications companies can't cheap out on this because the performance of the network depends on it. So you've got solar eating up half the supply, EVs taking another chunk, 5G infrastructure taking more. Traditional industrial uses like electronics, medical devices, and photography still consuming their usual amounts. And on top of all that, you've got investment demand that could surge at any moment if inflation fears return, or if there's another banking crisis or geopolitical shock. The math just doesn't work. There's not enough silver being mined to meet all this demand. And unlike gold, where most of the demand is investment and jewelry that can be recycled or sold back into the market when prices rise, silver gets consumed. It gets used up in industrial applications where it's not economically viable to recover it. Once it's in a solar panel or an electronic device, it's essentially gone from the supply chain for decades. I want you to think about what happened with palladium a few years ago, because it's a perfect case study for what might happen with silver. Palladium is used in catalytic converters for cars. When emission standards got stricter globally, demand for palladium surged. The price went from $500 an ounce to $3,000 an ounce in just a few years. It sextupled. And that was for a metal that had nowhere near the diverse industrial applications that silver has. Silver is used in more applications than almost any other commodity. It's the best conductor of electricity. It's the best conductor of heat. It's the most reflective metal. It has antibacterial properties. It's used in medicine, in water purification, in clothing, in electronics, in photography, in mirrors, in batteries, in brazing alloys. The list goes on. And now it's becoming absolutely critical to the global energy transition. Here's something else that should concern you if you're not already positioned in silver. The mining companies aren't investing in new capacity. Why? Because silver prices have been suppressed for so long that it hasn't been profitable enough to justify the massive capital expenditure needed to bring new mines online. It takes 7 to 10 years to go from discovery to production for a new mine. 7 to 10 years. So even if prices spike tomorrow, and mining companies decide to invest heavily in new capacity, We won't see that supply hit the market until the early 2030s. And by then, the solar industry will have already consumed whatever above-ground inventories exist. We'll be in a situation where industrial users are competing with each other for limited supply, bidding up prices to ensure they can keep their production lines running. That's when you see price spikes that shock everyone. When industrial users panic and start hoarding because they're worried about supply chain disruptions. Let me tell you about what's happening in the paper silver market, because this is where things could get really explosive. The COMEX trades about 150 times more silver in paper contracts than actually exists in their warehouses. It's a fractional reserve system, just like banking. It works fine as long as everyone doesn't ask for delivery at the same time. But what happens when industrial users start demanding physical delivery because they need the actual metal for manufacturing? What happens when investors lose faith in paper promises and want real metal in their hands? We saw a preview of this in 2021 during the Reddit silver squeeze. A bunch of retail investors tried to corner the physical silver market by buying up all the coins and bars they could find. Premiums on physical silver spiked to 30% or more above the spot price. Dealers ran out of inventory. Mints couldn't keep up with demand. And that was just retail investors buying relatively small amounts. Imagine what happens when large institutions and industrial users start competing for physical metal. The LBMA, which is the London Bullion Market Association, they're the other major hub for silver trading. Their vaults hold about 1 billion ounces of silver. Sounds like a lot, but remember, annual global demand is about 1.2 billion ounces. So the LBMA vaults hold less than 1 year of global demand, and a significant portion of that is already allocated, already owned by specific entities. The amount of truly available, unallocated silver is much smaller than most people realize. Now let's talk about what central banks are doing, because this is fascinating. Central banks don't typically hold silver reserves like they do gold, but some countries are starting to reconsider that. China, Russia, and India have all made noises about diversifying their reserves beyond just gold and dollars. Silver makes sense for them because it's both a monetary metal and an industrial metal. It's strategic. If you control silver supplies, you have leverage over the entire renewable energy supply chain. China's been particularly aggressive about securing supply chains for critical materials. They dominate rare earth production. They dominate solar panel manufacturing. They dominate battery production. Would it surprise anyone if they started accumulating strategic silver reserves? They've got the money, they've got the motivation, and they've shown they're willing to play the long game when it comes to resource security. Here's a scenario that keeps me up at night. What if China decides to restrict silver exports? They're the world's third largest silver producer. If they decide that all domestically produced silver needs to stay in China to support their solar industry and their electronics manufacturing, that removes about 100 million ounces from the global market overnight. Prices would absolutely explode. Western solar manufacturers would be scrambling to secure supply. It would be chaos. And it's not even that far-fetched. China's already restricted exports of gallium and germanium, which are critical for semiconductor manufacturing. They've shown they're willing to use resource control as a geopolitical weapon. Silver could easily be next, especially if tensions with the West continue to escalate. Let me show you what's happening with silver ETFs, because this tells you a lot about where smart money is positioning. The largest silver ETF, SLV, has seen consistent inflows over the past year. Not massive, but steady. Institutional money moving in quietly. They're not making headlines. They're not pumping it on social media. They're just accumulating. That's what smart money does. They position before the crowd figures it out. And then there's the mining stocks. Silver mining companies are trading at valuations that assume silver stays at current prices forever. But if silver goes to $40, $50, $60 an ounce, these companies' profits explode because their costs are relatively fixed. A mining company that's breaking even at $25 silver is printing money at $50 silver. The leverage is enormous. And yet the stocks are trading like nothing's going to change. I've been studying the 1970s silver market because there are some eerie parallels to today. Back then, you had inflation concerns, you had geopolitical instability, and you had the Hunt brothers trying to corner the silver market. Silver went from $6 an ounce in 1979 to $50 an ounce in 1980. It increased more than eightfold in less than 2 years. Now, I'm not saying we're going to see that exact scenario play out again, but the underlying dynamics of supply shortage and increasing demand are similar. The difference is, back then, it was driven by speculation and manipulation. Today, it's being driven by fundamental industrial demand that's not going away. Solar panels aren't a fad. The energy transition isn't optional. Countries have committed to it. They've signed international agreements. They've passed laws. They've allocated trillions of dollars in funding. This is happening whether silver prices cooperate or not.
And that's what makes this so compelling as an investment thesis. You're not betting on speculation, or market manipulation, or some temporary trend. You're betting on physics and chemistry, and the fundamental properties of silver that make it irreplaceable in certain applications. You're betting on governments' commitments to renewable energy. You're betting on the laws of supply and demand. Here's what I think happens over the next few years. Silver prices start grinding higher as the supply deficit becomes undeniable. Maybe we see $35, then $40. Industrial users start getting nervous and begin building inventory, which accelerates the price increase. At some point, investment demand kicks in as people realize what's happening. That's when you get the explosive move, potentially to $60, $70, maybe higher. The mining companies that are still solvent and producing will see their stock prices multiply. The ones that went bankrupt or shut down during the lean years won't be around to benefit. New mines will be announced, but they won't produce metal for years. Governments might start talking about strategic reserves. There might be export restrictions. It could get messy. And through all of this, solar panel manufacturers will keep buying because they have no choice. They've got contracts to fulfill. They've got factories running. They've got employees to pay. They'll pay whatever they have to pay for silver, because the alternative is shutting down production, which is even more expensive. This is one of those rare situations where you can see the train coming down the tracks. The data is public. The projections are clear. The supply constraints are obvious, and yet the market hasn't fully priced it in yet, because most investors aren't paying attention to industrial commodity markets. They're focused on stocks and bonds and crypto. They're not thinking about the physical materials that make the modern world function. But the people who are paying attention, the ones who understand supply chains and industrial demand, they're positioning now. They're buying physical metal. They're accumulating mining stocks. They're setting up for what could be one of the biggest commodity moves of this decade. The solar demand surge isn't coming. It's already here. The installations are being built right now. The panels are being manufactured right now. The silver is being consumed right now. And every month that goes by, the above-ground inventories get a little smaller, the deficit gets a little bigger, and the eventual price adjustment gets a little more inevitable. You can ignore it if you want. You can assume that somehow, magically, new supply will appear, or demand will decrease, or some substitute will be found. But the smart money isn't betting on magic. They're betting on math, and the math says silver is about to become a lot more valuable than most people think.